What is Warren Buffett's investing strategy? What is up, YouTube? My name is Wes DeVore, and in today's video, we are going to be talking about the man, the myth, the legend, Warren Buffett, the most famous living stock market investor. How does he do it? How does he pick companies to invest in? How does he evaluate and choose companies to really see which company is worth more? How did he build a massive fortune of $81.7 billion and become one of the world's most wealthiest people? In today's video, we are going to talk about his strategy. All right, so first and foremost, Warren Buffett is known as a value investor. So what is value investing? Well, if you like to buy things on sale, you probably have all the skills you need. Let's look at a quick real-life example. Let's say you want to buy a big screen TV. The Sharp 55-inch class LED TV currently retails at $430 from Best Buy. However, on Black Friday, you could purchase this TV for just $250, saving yourself $180 in value. In other words, 42% on $430. Let's say you wanted to purchase two TVs that year, one for your living room and one for your basement. In that case, you would be saving $360. Essentially, you would be getting $860 of value for $500. Now, apply this idea to the stock market and you have what is called value investing, plain and simple. Okay, it's a little more complicated than that, but you get the basic idea. You get the picture. Now, when applied to the stock market, you're actually a whole lot more fortunate because ideally you have purchased appreciating assets instead of a TV or two TVs, which are depreciating assets. So in regards to the stock market, not only did you build yourself in value when you purchased the stock, so to speak, on sale, but ideally the stock will also increase in value over the long term. The only difference between a Black Friday sale and the stock market is that on a Black Friday sale, you know when that sale is gonna be. In the stock market, you gotta do a little bit more research to find out what stocks are on sale. All right, so before we dive into Warren Buffett's strategy, we gotta talk about what is meant by value investing. What is a value investor? Because Warren Buffett is today's most famous value investor. There are many ways to compare the value of stocks, but in value investing, the most important comparison that you make is the stock's intrinsic value to the current stock's market value. This is exactly what Warren Buffett does, and this is also exactly what we did in the Black Friday television example. If you know the 55-inch TV is worth $430 and you acquire it for $250, you have an upside of $180. When the undervalued asset's price returns to its market price, you're in a pretty strong position. For example, when Black Friday ends, you could sell the TVs on Craigslist for about their market price. And each TV would net you a profit of around $180. That's a pretty good deal. Well, you can do the same thing on the stock market. Although, when you're value investing on the stock market, the idea is not to sell the assets right away, but to hold them long term. And this goes to one of the most critical points of value investing. In value investing, the investor considers themselves more of an owner than just simply an investor, because you've done a thorough amount of research and you have put your money in a very healthy and well-run business. All right, now that we cleared up the definition of value investing, let's get back to Warren Buffett's strategy. So number one of the most important things to understand about Warren Buffett is that he is not concerned with the day-to-day up and down supply and demand of the stock market. In fact, he isn't really interested in the so-called stock market at all from a trading point of view. Warren Buffett is more interested in becoming an owner of businesses that satisfy certain investment tenets. These include great management, consistent operating history, and favorable long-term prospects. His quote that in the short term, the market is a popularity contest, but in the long term, it's a weighing machine, is telltale of his long-term investment outlook. Number 2, one of the most important metrics in evaluating a company to Warren Buffett is return on equity, abbreviated ROE. Buffett compares the ROE of similar companies in the same industry to determine how efficiently the company converts shareholder equity into profit. This ratio's movement reveals how well a company knows how to reinvest their earnings. There's a lot more information about return on equity on the internet, so I really recommend researching this very important metric further, and a great place to do that is investopedia.com. Number 3, Buffett likes to see in companies that the majority of earnings growth is coming from shareholders' equity rather than money borrowed from a lender. This is to make sure that the company is not over-leveraged, which indicates risk because of large interest payments that could hamper a company's profits. Number 4, the company must have strong and improving profit margins. These metrics indicate how efficient a company is at controlling expenses and producing profits. In other words, how well the management is executing business. The profit margin is the percentage of net revenue retained as net profit. Let's look at a real life example and figure out Apple's 2018 quarter one's profit margin. So in quarter one 2018, Apple's net revenue was $88,293 million. Their net income was $20,065 million. So their profit margin was 22.7%. In other words, in quarter one of 2018, for every dollar of sale, Apple retained $22.70 of profit. That means if you bought a $500 iPhone, Apple retained $113.50 after paying all expenses. Warren Buffett's current largest portfolio position is Apple. Number 5. The 5th way Warren Buffett got insanely rich is by smashing that like button, hitting that subscribe button, and dinging that notification bell. So go on, do it. Hit the like button, hit the subscribe button, leave a comment, ding the bell. I really appreciate it. Number 6, value investing is about finding companies that have been around for a while so that they have a proven track record, and then determining if the current market price of the stock is undervalued. Warren Buffett doesn't typically invest in companies that haven't been public for more than 10 years. He looks for companies that have a firm stake in the ground. Buffett is very good about finding companies who have performed well in the past and then making a decision about how well they will perform in the future. And for that matter, will they be increasing their performance in the future? If not, Warren doesn't invest. If he concludes that the business will maintain that great level of efficiency and will potentially increase their level of efficiency, Warren Buffett will choose to invest. Number 7. Warren Buffett tends to shy away from companies that work in commodity industries. This is because companies who sell products that are commodities typically don't add much value to the product during production. This makes the product, the commodity, virtually undistinguishable from other competitors' products in the same marketplace, and thereby eliminates companies who sell commodities competitive advantage over one another. Number 8. This part is the tricky, more subjective part. Evaluating a company's financial statement using some of the metrics and some of the ideas that we just discussed is the easy part, since all this information can be found online for public companies pretty easily. The hard part is to determine whether or not the stock is really selling for a discount or not. So this is the most elusive assessment in value investing and the most elusive part when analyzing Warren Buffett's strategy for picking stocks. However, this is Buffett's most crucial ability. Buffett does this by comparing the company's total value on paper with other intangible values, like the company's brand, the company's reputation, and the goodwill of the company. When he combines those subjective factors with the company's book value, he arrives at the company's intrinsic value. Then he compares the intrinsic value of the company to the company's total worth or market capitalization. If Buffett's intrinsic value calculation is 25% higher than the company's market capitalization, then Buffett assesses this company as having value, and it is likely that he will invest in this company and purchase this company's stocks on the stock market. All right, everyone, so I hope you enjoyed this video about some of the pillars of Warren Buffett's investing strategy. He is one of the most famous bargain investors on the stock market, and his track record proves that his strategy is a success. Now, if you don't want to worry about all of these ratios and metrics and you don't want to do any research, then both Warren Buffett and I suggest that you just go out and buy index funds like the S&P 500 index fund or an index fund that tracks the total US stock market. And I have a ton of videos about how to build your portfolio based on index funds, how to balance your portfolio between bonds and stocks, and on how to decide which index funds to put in your portfolio based on a bunch of personal factors that I explain in those videos. So just remember, if you don't really care about all of this, go and watch my other videos about index funds, and that will be extremely helpful to you. All right, everyone, so in future videos, we are gonna dive way deeper into each pillar that I just explained in this video. We're gonna attack each point in more detail, so that way you can understand every point in the strategy at a mastery level. So stay tuned. Thank you so much for watching, everyone. Be sure to hit the subscribe button, smash the like button, ding the notification bell. Please leave me a comment down below. Let me know what you think. Let me know what your opinions are and what your thoughts are. I'd love to hear from you. Thanks again, and I'll see you all in the next video. Take care.